Good afternoon and welcome to the Sage Investor webinar. My name is Jin and I am a co-founder of the Sage Investing Group along with Maggie and Lana. Thank you so much for joining us today. So today we are very excited to dive in and just demystify the topic of the cap rate for you guys. Maggie, she would do the honor of presenting on this topic. So thank you very much, Maggie, for pulling this presentation together. Now, before I hand it over to Maggie, I want to make a little introduction about the Sage Investing Group. For those who don't know us, all three of us, we have a Big Four accounting background, which means that our background is rooted in audit and risk management. And as you know, auditors, if you ever dealt with them, are typically not people's most favorite professionals, unless of course we're on your side, because nobody wants to be audited. We're very detailed. We ask a lot of questions, and we never really believe anything that people say unless we see the evidence. So as a result, we do see a lot of value in what we do and how it can help other investors in the multifamily space. So using our combined 35 years of professional experience in audit, accounting, and finance, along with our thousands of hours that we've invested so far, underwriting multifamily deals, and our real estate background, we do feel that we kind of bring all those into what we do today in the multifamily syndication space. And that is we critically vet the deals that we offer to our investors so that busy professionals like you guys can invest with greater confidence in these syndications. So today we have over 245 verified members in our community and over 530 Facebook followers. And collectively, we have participated in 15 deals, which totals over 4,500 multifamily units with a portfolio value of more than $497 million. So evidently, we believe that multifamily is one of the best asset classes to invest in. So we've created this webinar series to provide educational content so that you can decide for yourself whether this is the right investment strategy for you as well. So this webinar is really for anyone who has tried to invest in syndication before, but ended up backing out. It's for anyone who is interested in syndications, but feel like you don't know enough to get started, or maybe you feel overwhelmed by all the information that is out there. So this is really a great place for you guys to continue just building upon your knowledge so that you're prepared for that next opportunity when it arises. And before we get started, I just want to make this one disclaimer that this webinar is really for your educational purpose. Although we are CPA and we have CPA backgrounds, Sage is not a legal, financial, or tax advisory firm. Please consult with those respective professionals for legal, financial, or tax-related questions. And please know that we cannot guarantee any returns, and there are always risks associated with any investments. With that, I'm going to pass it off to Maggie.
Thanks, Jen. So, okay, let's go over some key takeaways in today's webinar. Many investors get confused with cap rate simply because it is confusing. So we hope in this webinar, we can help demystify or clarify some of this confusion. First, we are going to go over the definition and calculation of cap rate. Then we will go over to cover how cap rates correlates to valuation, how to evaluate cap rate in a deal as an LP, and then lastly, I'm going to cover the one big shortcoming just using the cap rate to value your deal, which brings us to the tip of the day. Cap rate is relevant, but is not the most important metric to look at, especially in a value-add deal. And we'll dive in deeper on why that is the case in the next 20 minutes or so. So let's go. Okay, number one, let's get level set and go over the basic definition and calculation of cap rate. Right, a cap rate is simply the rate of return that is expected to be generated on an investment property. For the purpose of this webinar, we are referring to multifamily properties. Let's start with how this is calculated, and then we're going to go into what it really means. The formula for cap rate is determined by taking the property net operating income and dividing it by the value of the asset or the purchase price. We're going to geek out a little bit because this is a topic that we love to talk about and break it down this formula, but we're going to take a step back. What would you use a cap rate for anyways? Well, an asset cap rate may be helpful when evaluating a property that you're looking to buy and comparing that asset to something that had recently sold in the same market. And this is determined if that price that you're buying for is reasonable. And clearly, you do not want to be in a position to overpay if you can. But of course, you can't land on a deal if your offer price is also too low. So this formula helps sort of guide you to see if a reasonable range of price points so you can be competitive in your offer price. Now, for multifamily properties, it is a bit different in that the valuation of it is more like a commercial property. It's like a business, right, that has revenue and expenses, and therefore there has profits. How much money a business, it's at the end of the day, it's how much money this business can generate. The greater the income, the more valuable a business is. So where does this NOI fit into the cap rate formula? It is the numerator, if you will, of the formula. The higher the NOI, the more valuable a multifamily property would be, all else being equal. And for your reference, just by reversing the formula, you can calculate the value by taking the NOI and dividing it by the cap rate. So if you can imagine, you have more control on increasing the value of an apartment building simply by increasing the rent and or decreasing the expenses, thereby increasing the NOI. Of course, like any other business, there are external factors that can impact its value, but it is a very resilient asset class because fundamentally housing is a basic need. So in summary, cap rates are commonly used by real estate professionals because they are a quick and easy way to calculate value in a given market, but they are not without their shortcomings, and we'll explain that further. Okay. Number two, let's understand how cap rate relates to valuation. Okay, well, first question is how to use it. As mentioned, the cap rate may be helpful when looking to value an asset at a purchase and compare that asset to sell a similar property in the market to determine if the sales price is reasonable. For example, a buyer is looking to buy an apartment building that has a net operating income of $150,000. If the buyer knows that the market cap rate is 6%, the buyer can divide $150,000 by 6% and determine that a reasonable purchase price to offer for the seller is $2.5 million. On the other hand, on the flip side, if the seller is marketing a property for $2.5 million sales price, and the buyer requests to receive the 12-month income statement that shows $150,000 in net operating income, the buyer can determine that the asset is being sold for 6 cap, or 150,000 divided by 2.5 million, and compare it to similar property in the area to determine if the sales price is reasonable. Okay. Now, let's say we bought the property in the previous example. We were able to improve net operating income by $25,000 in year 1 after takeover, and the market cap rate is still at a steady 6%. Then your value of the property would now be $2.9 million. That is taking the $175,000 of improved NOI divided by 6%. You just have increased your value of the property by over $400,000. Moving on. Now, let's say the same scenario, but your exit cap rate is now actually 5.5%, meaning the market is doing really, really well. Perhaps there is a lot of job growth, people are making good money, and there are just tons of people flooding to the market, which creates more housing demand. And there's more investor bidding, and inevitably, there's more investors bidding on the properties in the market. For those many reasons, cap rate would go down or compress from a 6 to a 5.5%. So now improving that NOI by $25,000 in year 1 after takeover with the market cap of 5.5%, then your value of the property would be $3.18 million. That's taking $175,000 divided by 5.5% cap rate. Thereby, you just increase your value of your property by over $681,000. So same effort, but exiting in a better market. Now, the reverse is also true. Now, let's say the same scenario, but your exit cap rate is now at 6.5%, meaning the market is not doing so well as you have entered. Perhaps the population is declining, or employers are moving out of the market. So just to list a few examples, for these reasons, the cap rate will go up from 6% to 6.5%. So now improving the NOI by $25,000 in year one after takeover with the market cap rate of 6.5%, then your value of the property would now be 2.69 million. That's taking the same 175,000 NOI divided by 6.5% cap rate. Thereby, you just increase your value of property only by $192,000. So same effort, but exiting the worst market will therefore yield a lower return. Moving on. Okay, number 3, how to evaluate cap rate in a deal as an LP investor. Okay, in a syndication deal, a property is typically modeled in Excel to determine the projected returns. And of course, you want to be conservative in your model. As an LP investor, there's really 2 main questions to ask in regards to your cap rate if you want to determine if the underwriting is conservative. And they are: 1, what is the market cap rate for a similar property? And 2, what is the projected expected cap rate at exit, or also known as the reversion cap rate? So here is how we expect an answer using the prior example. If we bought the property with $150,000 of NOI for $2.5 million, which is similar to other assets that are trading in the market, and the plan is to hold it for 5 years before the sale. Now, we can't ever predict how the market will be in the future when we sell. So to be conservative, it's best practice to expect the exit at a higher cap rate than when you enter in. In other words, you're expecting the market to be worse than you entered. Typically, right now, we like to see escalation between 5 to 10 basis points every year. In this example, it is a 10 basis point escalation. So let's say we improve the NOI all the way to $300,000 in year 5. And with a 6.5% projected market cap rate, we're expecting the valuation to be around 4.6 million. In comparison, if we didn't use the escalation at all, and if we are using the same cap rate at purchase, in this case 6%, which means we assume the market to stay steady in the next 5 years when we exit, that projected valuation in year 5 would be $300,000 of NOI divided by 6%. That's $5 million. That's about $400,000 difference in comparison to the model. So for now, at this point, we don't think the market cap rate would trend higher, but we always like to build in some cushion in our model. So let's just say if we're using this escalation, we are still able to meet the target return, then if the market really actually does better, then that would just be gravy. Okay, number 4, shortcoming of using cap rates. Okay, the number 1 of questions is, if I am buying at a lower cap rate than the going in market rate, does that mean I overpay, right? Well, the answer is no, not necessarily. Cap rate shortcoming number 1 is that cap rate can be meaningless when determining the value of the property for acquisition if the property isn't stabilized, either because the rents are lower, the vacancy is higher, or expenses are just greater than comparable asset in the markets. For whatever reason, you know that the NOI is not being maximized. In such instances, applying the market cap rate will not achieve an accurate pricing because there is room for improvement, allowing opportunity to maximize the NOI by implement a value-add business plan. A value-add business plan is generally requires adding capital improvement at cost, increasing rents, and decreasing expense. So as example, on the next slide, as an example, a deal lands in your inbox with a net operating income of $50,000 and a price tag of 1.6 million. If you calculate the cap rate, that will equate to a 3.1. That's pretty low, right? In addition, you know that the going cap rate for the stabilized product in the area is 6%. And if you calculate that $50,000 over 6% market cap rate, you might end up a false valuation or valuation of $833,000. Practically, you're offering half of what the seller is asking. So now, if you know that the deal it has potential, and perhaps you know the current rents are super low and the expenses are super high, and you're able to execute a business plan that can improve the NOI with a pretty high confidence. Let's just say you're able to increase net operating income by $100,000 in year one, to $150,000 in year two, $175,000 in year three, $200,000 in year four, and $225,000 in year five. The price that you pay for the property doesn't change as you improve your NOI. So now your internal cap rate is actually 6.3% in year one in comparison to the market cap rate, 6%. Meaning for each dollar you spent, you're getting a better return than the market in year one already. And it's get better in year three, year 2 to 5, where your internal cap rate reaches to 14%. Okay. And let's just say while you are working on this business plan throughout the 5 years, the market cap rate stays at steady 6% stabilized product or stabilized. So at year 5, your assets should be stabilized. So if you apply your improved NOI in year 5 of $225,000 and divide that by 6%, you get a valuation of 3.75 million. So suddenly that 1.6 million that you spent in year one doesn't look that expensive anymore, right? So hence, cap rate can be meaningless in determining the value of the property for acquisition if the property isn't stabilized and there's value add that you can implement. The key here for value add deal is really the business plan and the people executing the business plan. So with that, just some takeaways that we want to go over. So cap rate is calculated by NOI divided by purchase price or valuation, or you can flip it around to find purchase price is equal to NOI over cap rate. And third, making sure as an LP investor, make sure that you are reviewing, when you're reviewing a deal, that the model the syndicator is using a cap rate escalator. And lastly, cap rate can be meaningless for value add projects, as we discussed. So with that, I'm going to turn it back to Jen.
Thank you, Maggie. Sorry, I had to unmute myself. So with that, yeah, we are now open to any questions that you guys may have. Feel free to either type into the chat box or you can unmute yourself. And I know usually it takes people a little bit to come up with some questions. So while we wait for these questions to come in, if you guys are interested in learning more, anybody who's new here, if you're interested in learning more about the Sage team, and if you want to invest with us on future deals, we encourage you to connect directly with us. We can be reached at info, if you have a pen and paper, info@sageinvestinggroup.com. And we'll email the replay to you shortly after this, so then you'll get our email address that way as well. So we encourage you to connect directly with us. And also, if you know somebody who might also be interested in learning more about investing in real estate syndications, we'd love to help people that you care about as well. You can just simply refer them to our website, sageinvestinggroup.com, where they can simply click on the Join Now button, fill out a questionnaire, and most importantly, set up a call with us so we can get to know them better and see if what we have to offer fits their investing strategy. So with that, I gave you guys a moment, hopefully, to think about any questions that you may have for Maggie. Let's see. Aaliyah says she has a question.
Hey guys, how are you doing?
Hey Aaliyah, good. How are you?
Hey.
Thanks for joining us.
So one of the things that I think is interesting about cap rate especially the difference between maybe someone who has been investing in the single family market compared to the multifamily market. So I think that, a lot of investors are coming from single family. And at least where I am, which is in the Seattle area, is our cap rate is like at 2%, right? Which is kind of horrible if you want to say it that way. But the difference is that our equity that we build in our property is astronomical, right? So we have some cases 15% on a yearly basis for the properties, but our cap rate is really low. So for those people who have single family homes, how would you suggest taking that piece of information that I just mentioned to you and correlate it to multifamily for people?
Sure. So thank you, Leah, for the question. And congratulations for having a very successful single family business. That's amazing. So that's one of the things that you are really why we are drawn to multifamily from single family, because we also started with single family. The thing is that with single family and up to even 4 units, your value is actually really dependent on your competitors in that same market. So your neighbors or whatever, it's going to stay there. And in comparison to multifamily, it operates more like a business, right? So it's really dependent on how much income it can generate. So I would say that it's more in your control. I feel like it's more in control versus in single family, you're really dependent on the market appreciation, which you are successfully, and that's great. But that also want to caveat, you never know, you can predict the market. So it's kind of outside of your control. So in this case, that's why we are tended to be more, for myself, I'm more favorable in multifamily because I feel like there is more control components that we can take on. So that answer your question, Leah?
Yeah, no, I just was curious what your take was on it, because obviously a lot of our investors are coming from the single family portfolio. So, and, at least my mindset was, the more rent I can bring in, that's awesome. But in our area, of course, is that does not correlate with being able to have a passive income stream that you can live on. So I think that's one of the things that's interesting about single family to multifamily is that, let's say you invested $100,000 in a single family home, and maybe you're getting, I don't know, 900 or 1,200 in a rent or in some form of that, is that if you invested 100K into a multifamily, you're getting what I know you guys are eventually going to go over is this cash on cash return, which is sometimes 10% or more. And so if you invest 100,000, you're getting around 10,000 a month, or not a month, a year in your investment, compared to, in some cases in the single family situation, you're not really getting that at all.
Yeah.
So I think that's something to be aware of, and let alone the headache of having a single family home that you're renting, is that now you have to be on call for those tenants. You're dealing with those water heaters, the toilets overflowing, et cetera. And so I think the advantage to multifamily seems to be that, it now is run like an actual company, and you have lots of opportunities with that from the property management side, the operators such as yourselves, really looking over having those CFOs, COOs, CEOs of really a company, compared to that we're being all of those hats in the single family portfolio that we own ourselves. So cap rate is a great way in single family to sort of look at what's going on. But again, we know it's not the end all. And it seems to be that's the same thing in multifamily, is that it's a great little quick way to analyze a deal, but there's definitely more that needs to be done before we just glance at the cap rate, because it's going to depend on the area. California's cap rate is horrible, compared to Alabama, right?
Yeah, same for Northeast side too. So we share the pain over here too. So it's at the end of the day, you have to kind of weigh your risk profile and your risk appetite, because I think you can make money in any kind of real estate as long as you start somewhere. It's just, it's also based on your risk appetite, right? Maybe you're the one person that wants to use a hammer and do all the work by yourself. That might be your risk appetite. You want to do all that stuff. That's fine. Everything is totally fine, but it's based on what you want to do and how much effort you want to put in there. So I think we can say, Lana, I think on some of our friends in Northeast side, they are buying at really low cap rates here in single family, really high, where they had to put in a lot of money, and they're not getting any cash on cash return. They might be in negative, and they're okay with that. They just that's
yeah,
normal.
I think actually, yeah, I was just going to chime in to share a story. So I actually have a friend here who invested in a single family so I'm in New York. So in the New York area, they invested in a single family as an investment property. And their objective here was New York will always be New York, even if the population has declined here. And we know the market is, a little bit volatile, but they still believe in it. And that's great. That's their choice. And they invested in this property. And I said, oh, okay. So how much rent are you getting? And is that enough to cover all your property taxes, all your utility bills, any insurance, all these little expenses that start adding up? And your goal is obviously not only to break even, but have a little bit money left over to have in your pocket, the cash on cash return, right? So I asked them, I was like, oh, great. How's your cash flow? And they're like, what do you mean? And I was like, well, how much profit are you keeping at the end of each year? And they're like, no, Lana, I invested. I know it's a negative cash flow, but when I exit in, 10 years, 20 years from now, it's going to be a slam dunk. And I'm like, yes, that's true. Your equity multiple is amazing here. But in the meantime, you're losing money because it's a negative cash flow investment. But for them, that was okay because they were looking for that yield and they were in the short term willing to sacrifice cash flow. That was their investment strategy. They were okay with that. And so I was like, okay. So each person's investment goal is a little bit different. But in that case, because they were fully aware it's a low cap rate market, wherever their investment is, they're going to have no cash profit at the end of each year, but they're investing for the purpose of, well, real estate's a hard asset, that's appreciation, all that benefit that comes investing in real estate, but also that market appreciation, that equity increase in like several years from now, whenever they decide to sell. So that kind of is a story that kind of encapsulates exactly what you're saying, Aaliyah and Maggie.
Yeah, I think that what people are fearful of, and even Neil and myself were going from the single family to multifamily. I mean, we did single family for over 14 years because, quite frankly, getting into multifamily was such a difficult thing. It was like we didn't have money to go buy ourselves an apartment complex until really understanding syndication. So the thing that's nice here is that you can take that 100,000, get some cash on cash return if you need it. You might be a W-2 and might not need it, right, to be able to deal with that. But there's more of an opportunity there for you to be able to absolutely double your money in that 5 or 6 year period, compared to, I wish I had taken that money that we had put and invested in our single family homes and been able to double that 3 times, because it's almost 15 years, like every 5 years we could have. Granted, yes, we're in the Seattle Pacific Northwest, which is acting like San Francisco and New York, but still there's this aspect of, gosh, the amount of things that we had to take care of ourselves were much greater and on our time. And, when you sit back and think that if you put 100 grand in the stock market, you have no guarantee that there isn't going to be a downturn. And the one thing about commercial real estate and multifamily in particular, because we went through a downturn in our single family portfolio as well, is that it's not so much related to the price of that property because you're holding on to it. There's renters there that are keeping that level so that your money really isn't being lost. So I feel that putting money into real estate in general is usually a better thing to do, because at least in 5 years, there's a good chance I'll get my 100K back, but there's a really good chance that I can get even much more than that if the operation of the multifamily was run well. And that's like what you guys were saying, is like you are using a 6.5% cap rate or 6 3/4 cap rate on the way out. And that makes things look kind of worse. But even if you just did it at the same cap rate that you had, that slide was great because it really does show you that just sitting there and having having that show up, there's a really good chance you guys are going to do really well. And that 100K is going to be a real nice bonus that you'll get at the end of that year 5. And you'll be able to take that and put it into another multifamily property and be able to do the same thing, which is one reason why it's sort of like not that you're going to put something in and forget about it. You do want to make sure that you know what's going on and you have good operators. But yeah, that cap rate really is amazing. And that 25,000 that you were showing about the NOI is another huge bonus of how we operate multifamily. So really great job. I really like what you guys are showing. And it's nice to see, explaining these things from the single family portfolio people up to the multifamily.
Thanks,
Yeah.
Elia. This is not
Yes.
planted at all. So thank you.
Yeah, no, thank you so much. It's so great that, you have such massive, single family experience. So you're tying it in to the multifamily now that you understand the benefits of multifamily, how it compares. So that's very, very insightful knowledge coming from you, Aaliyah. Thank you so much for sharing that.
Yeah, no, not a problem. I mean, we're all in the same boat here. I wish that I had learned this stuff years ago, but it's really nice to sort of see this. So I appreciate you guys doing this.
Thank you so much. And so does anyone else have any other questions? If not, I have something else. I do have a question. I guess not. Nope, nobody else is coming up. If you do have a question, feel free to just chime in. But I do have like one last question for you guys. So it seems like at the end of the day, you're saying that, you got to take the cap rate, the market cap rate with a grain of salt, right? So I'm just wondering like how, as Maggie and Lana, you guys do a lot of underwriting for our deals. When you vet our deals, like how does this cap rate play into the underwriting? If it's not that super important at the end of the day, how do you guys use it?
Yeah, let me just clarify. The market cap rate is not as meaningful when you're revaluing a deal that is not stabilized, or that they're not maximizing the NOI. So using the market cap rate in this example, it will not generate a really good, meaningful valuation. So where it comes to play in our underwriting in these cases, the market cap rate plays in the part when we exit. So like in this example that Lana put up, so we're projecting that right now we're saying that market cap rate is at 6%. We're projecting that the market cap rate is going to be worse. It's going to increase to 6.5, and that ultimately that equates to $4.6 million valuation. That number feeds into the investor return model. So instead of using a 6% where we expect that the market will stay there, we're expecting a lower valuation in the future. So, and that number, if that feeds into our investor return that we find is acceptable today, I think if we do better, that will be great. So that's really the number that we are putting in the underwriting, the projected return, projected cap rate, sorry.
Yeah. So just to kind of summarize really quickly, how cap rates relate to us from an underwriter is we just want to see what cap rate are we using in our model at the time where we enter versus what's the cap rate what we're looking at when we exit. And that's all baked into our model. And ideally, we'd like to see that the cap rate looks higher. So in this case, 6.5 is higher than 6% because that just means we're being more conservative in our valuation because we don't know what our valuation will be in 5 years, but we can approximate, and be more conservative in the investment returns. The more conservative, it just means we have more headroom to either meet or beat those expectations. But, undersell, over deliver.
All right, thank you guys. If nobody else has any other questions, but if you do think of anything else, feel free to email us. We'll send out the replay, and then you guys can just reply to that email and ask us any other follow-up questions. But we hope, today's presentation on the cap rate was very helpful to you guys in understanding what this number really means when you're evaluating a deal. So with that, thank you so much for joining us today, and we hope to see you again on a future webinar. Thank you guys. Have a great rest of the day. Bye.